Anand Tandon joins us. Anand, good morning. We've suddenly seen the markets punishing all the heavy debt stocks. What's happening? You think yesterday anything fundamentally changed, or is it just that all the news is out of the way, so people would have anyway sold?
Well, I think it did fundamentally change. The fact that the governor has actually said that the economy is headed towards stagflation is not good news. You know, he is, in my view, clearly behind the curve. All talk of saying that we are going to be data related is, to put it mildly, not reflecting data that we see, but data that we would like to see. So it is not surprising that if you really have a view that the governor doesn't have place to cut rates, at the same time the economy is going to slow down, why would you hold on to stocks which are dependent on interest rates and have huge debt?
Okay. Would that, Anand, also include private banks?
To a lesser extent, but yes, it would. I mean, the private banks also suffer from the fact that they are very highly overvalued. And, you're not seeing credit growth happening at all. So how do you make money if you still are growing at 10% overall credit growth? Then how much can you push in terms of the consumer lending? Finally, you have to also have a portfolio which lends to the corporate sector, and that's clearly not borrowing.
Okay. How much of further falls can the market see? I mean, after all, we are still in a plentiful global liquidity scenario. So does that put a floor? Would it be 8,000, 7,800, 7,900?
Well, that is the irony right now, that you have a situation where we are deflation everywhere else in the world, and we have a governor worried about inflation. So in that context, it's difficult to say how far it can fall. Obviously, many of the stocks look very attractive in the context of how far they have fallen. But if you look at the valuations, even now, many of them are stretched. So, a few hundred points more on the Nifty may be possible. So I would be very surprised if you don't get a rally before you see a further slip.
Okay. Anand, two stocks which are impacted because of news which is other than the economy or interest rates, it's ITC because of news yesterday, as well as Nestle. Would you be a buyer, or would you sense an opportunity on two FMCG stocks that used to trade at extremely high premiums, or still do? Do you expect the valuations to come off?
I think the two cases are different. ITC, there has been regulatory attempt to try and reduce the sales. I don't think that yesterday's Maharashtra government move of saying you cannot sell loose cigarettes is going to make a material impact. In fact, I think it will give them an opportunity to innovate like many of the FMCG companies did, which is that you may find single cigarettes being packed as single cigarettes. So they'll be packed but sold as single, and in which case you may find that they are able to actually increase the yield per cigarette.
Okay.
So I would argue that ITC for that particular reason is not a good sell. That aside, the fact that they have been slowing down in volumes is a problem, and that's a little more fundamental issue. Nestle, on the other hand, is right now completely news-driven. If the fact is true that they have a problem with the product, then, all hell will break loose.
Okay.
If, however, there is only an issue of, some samples being corrupted, or perhaps, some fraud samples coming out which are not manufactured by Nestle, then this would in hindsight look like a good opportunity to buy. But again, you have to remember that none of these companies are cheap. At least Nestle isn't particularly cheap.
Fair point. Anand, we'll leave it at that. Thank you very much for joining us with that quick take. So there, the market responding to dire forecasts on the economy.